The debt will now grow from 31 trillion today to 56 trillion in 2036. So it is not stopping, folks. We are looking at an average of 2.5 trillion per year from 2026 to 2036. Also, currently we're at 120% debt to GDP. House Committee on Budget expects it to be 135%, so slightly up in 2036. For comparison, Japan is 237, Singapore 176, Venezuela 164, the Greeks 154, UK 94. 20 years ago, our debt to GDP was but 60%. Here's a direct quote from the report. The fiscal trajectory is not sustainable. Okay, Dr. Doom. Bum, bum, bum. What do you think, Friedberg? This is your story, your chance to shine.
Well, there's no outlook to 3%
There he
deficit
is.
to GDP. There he is. And if you look at the assumptions, one of the key assumptions is that the short-term interest rate, which is largely how a lot of the debt is getting refinanced, is modeled to be around 3.1%. But if rates climb closer to 5%, as I mentioned in the past, just using the current debt levels, it adds another $650 billion a year of interest expense, which takes interest expense almost up to $2 trillion a year, just paying the interest on the past debt. And because we're running a deficit, that new interest expense increases the debt every year. So the debt goes up and up and up just by adding interest on past debt. And so this becomes the death spiral that we've kind of highlighted many times. So there's nothing in this report that I think changes the outlook. It's pretty scary. I'll say that the trigger point that I'm getting more and more concerned about, if the Democrats win the midterms and you end up with a Democrat in the White House in 2028, I think that there's a bigger problem at foot, which is all of the state and local obligations. We've talked about Social Security. Looks like it's going to run out of money in a few years here. And so they're going to need to print a lot more money to fund Social Security obligations. It's very unlikely they're going to make a massive cut to Social Security because no one will get elected if they did that. And no one will get elected if they promise to do that. And there's a similar problem at the state and local level, which is that there's pension obligations. We've talked about this extensively. California has nearly $1 trillion of unfunded pension obligations to its public retirees or public employees that are going to retire. If you end up with a Democrat-controlled House and a Democrat president in 2028, you'll very likely see a federalization of that obligation, meaning that the federal government will step in to bail out or support those state and local governments, because otherwise there's going to be a real kind of economic crisis afoot. So when you add that liability coming to hit this CBO report, which doesn't include any of that in the next 5 to 10 years, I think that could be not just the straw that breaks the camel's back, but the concrete that breaks the camel's back. And that's the thing I'm most worried about. There is a deep connection between what's going on with the socialist movements at a city level and now increasingly at a state level, and what we should expect to happen with the US dollar and how it relates to federal spending and federal deficits and federal debt. And these are going to be dragging each other into a bad place in the next couple of years, one way or the other. So, that's kind of what I'm more worried about at this point. It seems if it's very hard to cut spending or get Congress to approve budget cuts that we need to save ourselves from this death spiral, imagine how much worse it's going to be in the next couple of years if we have to bail out or federalize state and local debt and state and local pension obligations. It's going to be really nasty. So that's the thing I worry about the most in my Dr. Doom hat. Yeah. And I think that's one of the things that no one talks about at the federal level, and everyone ignores it because they assume it's a state and local problem. As we've talked about, and I'll bring it up again, and I'll ask my colleague who works in the administration to think about this idea that, if we can find a way to declare bankruptcy, to restructure the fiscal obligations or the pension obligations that sit at the state and local level, we may have a way out. But short of that, that's going to pile onto this federal problem.
Sachs, your thoughts on the CBO report and this death spiral?
Well, we all agree about the problem of federal spending and the deficit and the debt, and we're all concerned about that. With respect to the CBO study, however, I'll just note that one of the key assumptions here is that CBO projects that real GDP will only grow by 2.2% this year. in 2026. That's a very low assumption given that we grew by over 4% in Q3 last year, and the preliminary number for Q4 was over 5%. And I think all of our predictions for GDP growth this year when we did our predictions episode was 5% plus. So 2.2% is a pretty low number. And then they predict that it's going to slow to 1.8% after 2026. So again, these are very meager, anemic growth assumptions. And if you believe that all of this CapEx that's being invested in AI infrastructure is going to have a payoff, then the growth rates could be a lot higher. And that ultimately, I think, is the way to get out of the debt spiral is we need strong growth. Without that, we're not going to get out of this problem. So look, I think that if you believe in growth, then the situation is not quite as dire. What would I do? Well, I mean, if I could wave a magic wand, the two key charts you want to look at are federal net outlays as a percent of GDP. This is from Fred, right? And then you want to look at federal receipts, which is tax receipts as a percent of GDP. And you just don't want those lines to be more than, call it 3% apart. I think that's what Secretary Bessent said, is try to reduce federal deficits to 3% of GDP. Historically, tax receipts have bounced around 17%, and the federal net outlays have bounced around 20%. So if you get back to that, we'd be in pretty good shape. And we were. Before COVID, our federal net outlays, which means spending as a percent of GDP, was around 20%. But then with COVID, it bounced all the way up to 30% in 2020 because of both a function of all the stimulus, but then also the fact that the economy shrank because of COVID. And we've never quite gotten back to that magic 20% number. Right now, it's trending around 23%. So we're doing a lot better than we did under COVID, but it's still just a few percent higher. I mean, if it was up to me, I would just freeze federal spending until the economy grew to the point where federal spending as a percent of GDP is 20%. And then you could let federal spending continue to grow as the economy grows. And we're not even talking about cuts here. We're not even talking about shrinking the size of the government. We're just talking about limiting the rate of growth until the overall size of the economy can catch up with it. But look, as we know, it's very hard to get Washington to go along with that because there is just a lot of spending pressure in Washington. One thing I will say, though, I mean, just to give some credit to the administration here, is that the level of federal employment is at the lowest level since 1966. So during President Trump's second term here, we've gone from roughly 3 million federal employees to a little bit under 2.7 million. So, over 300,000 federal employees have been cut. I think that is a good start. I mean, you've 10%
seen... is a good start for you.
But by the way, course, I think that's really important to just pause on, just so people understand. This isn't like some hurtful thing about firing people, they lose their jobs. But when people move from the government workforce into the private workforce, they become productive. They're making things that grow the economy, and theoretically, they should also make more money. So this is positive from an economic point of view to move the workforce from public to private. It also, to my point, historically, I think it's very important to avoid the socialist spiral that if you have too many people employed by the government, it becomes impossible to not employ people by the government. And that becomes ultimately de facto socialism.
Chamath, your thoughts here? Obviously, great thing that we're shrinking the size of the government. Those people becoming more productive going into the private sector. That's a big win. We all agree. 10%, great job in the first year. Hey, maybe 5% the next 2 or 3 years would be even better. But the debt continues to be a problem. Are you worried? Do you think there's a solution here? What would you do if you were running the show?
I think you have to take a broader historical context to this. Does debt to GDP matter? It depends on many things, but mostly I would say it doesn't matter. And it's very easy for people to get agitated about that. Now, there are things that matter when you print too much money, which is the value of the dollar, the value of exports, the cost of imports, and how to actually protect your earnings and your wealth. That's a different question. This is a historical look back from about 300 years of debt to GDP of the largest functioning economies in the world. Now, what do you see? What you see is the trend where if you smooth it out for wars, which, by the way, has this weird effect of first escalating the debt to GDP, but then severely impacting it in a positive way. the Napoleonic War, the Franco-Prussian War, World War II. These things all had positive effects on bringing debt to GDP once the war was over. But the general trend since 1700 to now is up and to the right. And the key observation is that it moves in unison, that these things are relative problems. So if the entire world moves in unison like this, there is an argument to be made, which is that you could end up at 300, 250, 200% of debt to GDP. But if everybody is there, nothing really changes that much. The real question is if one country is able to decouple itself and its economic output is so meaningfully different than everybody else's. So my first take on this whole debt to GDP thing is I think you have to look at it together as a group. Separately, is it important to contain the debt? Absolutely, but for these other reasons, for earnings, for inflation, for all of those very practical reasons that impact your daily lived life. And what do we know there? We know that President Trump was elected on a massive mandate to secure the border on one hand, but to look at waste, fraud, and abuse on the other. And on that side, what did he do? He drafted the most important and prolific private businessman in the history of the world to be his tip of the spear. And what happened? They identified hundreds of billions of dollars, but when it came down to it and Congress had to act to solidify these cuts, they haven't done much of anything. Which is a way of saying that if the most conservative Congress in the history of the United States has not done much to solidify these cuts that were identified by the White House and DOGE, then, as Friedberg said, it'll only get worse if there's ever a Democratic House and Democratic control. So what do we have to do? I think we have to just acknowledge that if debt to GDP continually moves in unison, the music isn't up for a very long time. That's just an observation. I'm not saying it's right or wrong. It's just the observation. But you got to find ways of hedging and owning real durable assets because the underlying currency that is used in these economies, even on a relative basis, will fluctuate wildly and just fall off of a cliff, which will mean that it will erode the value that you have created for yourself and your family. That, I think, is the most important takeaway from all of this, which is we probably see things like gold do much, much better over time because people will be afraid about the durability of their dollar-denominated resources. But it will also be true for all these other denominated resources. But I think debt to GDP, quite honestly, if I had to be a betting man, will trend into the 2, 3, 4, 5, 600 on a relative basis for all countries. Because I just think the governments of these countries are addicted to spending and there is no reason to stop, safe of some other planetary species invading planet Earth.
Yeah, a black swan event, yes.
Yeah.
There's also a question of what Fed action will do to the capacity for excess deficit spending. So if Kevin Warsh really does want to tighten the Fed's balance sheet, and the Fed is effectively the first in line buyer of treasuries, meaning they are printing money to fund the government spending, and they slow down or actively slow down and stop doing that, then there is a real kind of question on what action will Congress and the administration need to take. Because what will happen, as you know, if the Fed stops buying treasuries, Treasury yields will go up. And if Treasury yields go up, that means the interest on the existing debt will start to go up. And if that lasts for a period of time and you start going from 3.5% to 4% to 4.5% to 5% on the short end of the yield curve, then it starts to become way too expensive to fund this level of deficit spending because the interest expense will just start to climb and eat it all up. So I think like the Kevin Warsh question is if he really is going to reduce the balance sheet, what's that going to do to rates? What's that going to ultimately force Congress, force the administration to do with spending?
Jason, what do you think?
We are in a consumer-driven economy, and the employment rate in this country is absolutely fantastic. So just 3 quick charts here. This is the number of job openings we still have, even if we burned off in 2022 from 12 million to 7 million jobs. We still have a ton of jobs available. Then, if you look at our unemployment rate, it's still at historical lows for our lifetime. If you were born in 1970, This is as good as it gets. 4.456 is what it's been. It's ticking up modestly, but still lowest of our lifetimes. And then finally, the employment participation rate, number of people in our society who are working and able to work. It peaked at 68% or so during the Clinton years. And this is still low, 62%. We still have people who could be participating. So all of these problems will be solved if more people were to participate and take those jobs. Why don't they take those jobs? Sometimes it's a geographic mismatch. Sometimes it is a skills mismatch, but very often it is the jobs are not paying enough. So if you want to give Trump his flowers, by closing the border, you've reduced the number of people taking the jobs off the books. And then you have the businesses are going to have to raise their minimum wage. They're going to have to raise their offering wage, which then might get this 7% or so that are sitting on the sidelines to take their jobs. Crazy prediction. I wouldn't be surprised if we see Trump, who is obviously a populist, and I tweeted about this the other day, got almost 500,000 views or 400,000 views. What if Trump decides he's going to raise the minimum wage? Not saying I endorse this or not, but it's incredibly low at $7 an hour. Obviously, in different cities and states, it's 15 to 20. But what if Trump said we're going to add $1 to it or $2 to it over each year of the next 3? This would be incredibly popular. And it would get some of those people off the sidelines and maybe take these jobs. So just a crazy prediction there, but I think it's a possibility. And I think they're going to lose the midterms as it stands right now. It looks like, I think that's the consensus opinion. And they haven't been able to do something with this affordability. Well, I think most Americans would say if you raise the minimum wage, that would increase affordability. You could make the counter argument it's going to just be inflationary, but I think most Americans are going to believe in that. So I wouldn't be surprised if you saw Trump take action there, because he does take populist actions like this from time to time.
You actually reading the economic literature on what raising the minimum wage does?
Yes, it can increase inflation and it can raise inflation and it can lower the profitability of businesses. Yeah. And move stuff offshore. Yeah.
No, what it does is it makes it illegal to hire someone whose labor is worth less than the minimum wage. And so it is shown to create higher unemployment in those segments of the economy. It's like one of those core findings of economists. So yeah, it's true that some people will be a beneficiary of getting a higher minimum wage, but then there'll be other people who just lose their jobs. And it creates an incentive for those employers to shift more labor towards automation. So if you're already worried about those people losing their jobs to automation, that's the downside. So anyway, if the minimum wage were a panacea and it just increased everyone's living standards without having downsides, why wouldn't you make the minimum wage $100 an hour?
2 hours, 11 minutes,
everyone
2
would just
seconds.
keep raising it infinitely. Obviously, it doesn't work
steps.
because if you raise the
Heart
minimum
rate,
wage
92 beats
too
per
much,
minute.
which is to say more than the value of someone's labor, then they just get unemployed.
Looking at what happened in the different cities or in Australia or other countries, they have a much higher minimum wage and they have much more happiness. Businesses and prices go up about 20%, 10 to 20%. So in Australia, if you go to a restaurant or if you go to a Scandinavian country, things might cost 10%, 20% more, but you have a happier population. And yes, it could lead to more, automation. We got rid of cashiers because it became too expensive in New York to pay $15 to $20 for a cashier. Sure. But we have really low minimum. We have very low unemployment now. And the businesses can clearly afford to pay an extra $1 an hour or $2 an hour. So there's the theoretical academic argument, which you are correct on, and I understand it fully well. And then there's the reality on the field, which is Seattle, San Francisco, New York, Los Angeles, Australia, other places have a much higher minimum wage. They have higher happiness in the population. I don't actually think it will have any impact because I think it's artificially low. But that's just one man's opinion. I think it would change the game here in America. And I think it would actually do something to your concern, Freeberg, about socialism. I think that if people felt that there was a, kind of a backstop against this low cost of labor, it might actually make people pretty stoked, that they could get a higher paying hourly job. And it might take some of that edge off in the same way universal healthcare might do that. But again, just one man's opinion.
I got to say on all this economic data, that I think we're kind of missing the lead here, which is we are at the beginning of an economic boom. Again, we saw it in the GDP growth rates in Q3 and Q4 last year, over 4% Q3, over 5% Q4. We just had a January job report where the economy added 172,000 new private sector jobs. This blew away the expectation, which was around 70,000. At the same time, the government shed 42,000 jobs. The net of this was to bring the unemployment rate down to 4.3%. So I remember a few months ago, J-Cal, you were wringing your hands about the fact that the unemployment rate had ticked up. Well, now it's back down. And you're seeing a lot of jobs being created in construction, especially non-residential construction. Has to do with the data centers, the AI boom that's going on. 33,000 new construction jobs in January. You've seen in President Trump's second term, you've had 615,000 new private sector jobs have been created, while, again, like we talked about, over 300,000 government jobs have been cut, which increases the productivity of the economy, and it does what Secretary Bessent says, which is reprivatize the economy. So I just think that the overall economic news is really good. Again, we have this AI boom going on. There's a new chart showing that the CapEx for this year that's expected just from the 4 leading hyperscalers is $600 billion, just from 4 companies. That's a roughly 2% tailwind to GDP growth right there. That is just the CapEx. That doesn't include all the ROI that you might get from that infrastructure on the software side, on the application side, the productivity side. So we have a boom going on, and I feel like everyone's kind of blackpilling about this. They're focusing on this
I agree.
CBO report that has unrealistically low growth rates.
We're going to print 6%.
Right. Or they're
6%.
doom scrolling about Epstein or what have you. And I just think when we look back on this period, it could end up being a little bit like the late 90s. Remember when we had, we look back on the late 90s, we're like, wow, we had like phenomenal economic growth.
Golden age. Yeah.
Golden age, economic
Labor
boom,
participation
the internet.
Snuck up on us there too.
Right. But
Zero
if you
debt.
remember what politics were like at that time period, all anyone talked about was whether Bill Clinton got a blowjob from Lewinsky. So my point is just, again, I'm not sure we're focused on the right things. I suspect we'll look back on this time period as the beginning of a new golden age.
I agree.